Hi, this is Brett with Trade Therapy. Welcome to the Trading Couch. We are talking about super microcomputer. SMCI was our clarity spotlight last week. It's a great opportunity for us to cover the entire institutional business cycle because we've been covering SMCI since it's gone through every stage of it. So if you care about trading structure, if you're tired of chasing headlines and tired of being exit liquidity and want to learn about how Wall Street rotates in and rotates out of positions, you should stick around and watch this. This is what the big picture looked like back in June of 2024. SMCI had just gone on this violent uptrend where institutions pushed price up into this parabolic territory, drawing in retail chasers. But if you look at what happened next, right about the time the headlines of S&P 500 inclusion for SMCI, if you look at what happened next, volume spiked here at the top. We see this big volume shelf develop in the volume profile there. These are obvious signs of distribution. Those of us that study the cycle and those of us that study technical analysis recognize those as obvious signals. We then started covering SMCI as it went through its distribution period here. Whenever you see volume spike at the top and then supply be brought into the market, these are obvious signs of distribution. This was right about the time when the yen carry trade was happening, when the DeepSeek AI bubble headlines were occurring. Wall Street and institutions were taking profit out of the Mag 7 and out of SMCI here after it went on this violent run. Institutions in Wall Street have to recognize profits just like we do. And this is their process of doing that is what leaves behind these structures, these Wyckoff structures or institutional business cycle structures. As all of these headlines were happening, Wall Street was taking profit out of SMCI and quietly taking short positions. Because if we take a look at a clean weekly view, this is a clean current weekly view of SMCI, we see that distribution period that we were just taking a look at. After distribution occurs, short positions are taken because institutions and professional money are interested in driving price down so they can reaccumulate their position. They just had a very successful run with this asset. They need to take profits. They need to get price back down where they can reaccumulate it. And they typically do that with negative headlines. SMCI was hit, I believe, with audit concerns. Their auditor stepped away from SMCI. And those are the excuse that is used by professional money to dump supply onto the market and force price down. After this initial drop here, there's a redistribution period. Typically in this stage, retail investors are drawn back in. They believe that they've bought the bottom. They've perfectly timed this. But what's actually happening is the initial round of profit is being taken from the short positions that were taken. The short positions are then being reloaded as the negative headlines magically seem to reoccur, and auditor concerns and regulatory compliance concerns are re-raised with SMCI. And you see this violent sharp down here in the second markdown stage. So the first stage, then redistribution, and then the second stage, followed by a very short abbreviated accumulation period where volume steps in. Professional money bought the dip. They do have a tendency to very quickly and sharply drive price up during their accumulation process here to lure retail traders in, only to then turn around and sell back into them. This allows them to compound their money. They take profit from these lows. They sell them into retail as they draw them back in, and then they force price back down and reload their position all over it. So if you're interested in understanding institutional positioning, especially as we're looking at here, we see price coming out of this low. We see moving averages beginning to support price. They're starting to turn up here. It appears that a new uptrend may be beginning. If you're interested in getting very quick insight into how institutions are positioned, it's always a good idea to look into the leveraged ETFs. This is SMCX by SMCZ. That's the long side of the trade by the short side of the trade. So you can see which side of the trade is stronger than the other. And we can very clearly see the short position taken here with these elevated volumes, that supply being dumped in, institutions trying to go short on SMCI. We can see that short supply being absorbed right here as long positions are taken. And then we see volume coming in to support that long side of the trade. And now the long side of the trade is moving up and out of the range and continuing on. So that does support a long view for SMCI. If we look at our daily annotated chart right here, we can see that SMCI is coming out of this triangle here. All of the moving averages are supported. This is classic rotation, classic late stage accumulation and potentially reaccumulation right here. It appears that all of the pieces are in place for SMCI to move out into a new uptrend, including divergence here. So what's the takeaway? The takeaway is this isn't guesswork. Studying the cycle and understanding the obvious signs really is just about educating ourselves. It's about studying the cycles. It's about recognizing distribution to markdown, to redistribution to markdown, and accumulation, all setting up for that markup period. If you want to stop trading headlines, you want to start trading structure, this is what we do in Clarity every week. If you found this breakdown helpful, make sure to follow along. We do this every week to help traders read what institutions are really doing. To get all the charts, check out the full article. That's all we got on SMCI. We'll see you next week.